What is going on, everyone? Steve here at the IBC Global. In the video you are about to see, we are going to walk through contract language and specifically how a policy can be set up for maximum cash value with a 1090 design, meaning 10% base premium, 90% PUA, maximum cash value. This video was actually produced about 2.5 years ago. It was designed for our agent training business, ILS Agent Academy, and we walk through actual language that exists in the illustration of a particular policy and then the full contract. What is really interesting is you'll see what the standard PUA limits are that exist with a company. You'll see that in the illustration, but then you'll see in another part of the contract additional provisions that exist that allows a policyholder to dump more money into PUAs and maximizing that cash value. So I hope you enjoy it. If you have any questions, please reach out. If you really enjoy it, hit that like button, subscribe for more, and we'll talk to you soon. Here, we are going to take a look at a Guardian life insurance policy. Guardian is known as one of the more flexible life insurance companies out there. And when I say flexible, I'm regarding the PUA payments. I can add PUAs into the policy at leisure, and I can have a lot of flexibility if I set it up properly. So up on the screen, we have a policy on a 40-year-old male. You see $50,000 per year paid into the policy. Now, when we look at the design, we have a $5,000 minimum premium. You see a $5,000 scheduled PUA rider, and then you see $40,000 going into unscheduled payments per year. Now, when you look at the net cash values, looks great. Breaks even just about year 4. This is optimized for high cash value performance. Now, it is important to be aware of the insurance company's limitations. While this illustration looks great, the contract language, specifically in the full illustration, can contradict what we're doing here. And the last thing we ever want is to show someone a policy, they're ready to go, and then they read the full illustration and they see something that contradicts what you've shown. Or your competition points it out and they doubt your credibility then, makes life difficult. So next we're going to look at page 3 of the full illustration. So on page 3, you've got a lot of language here, but up top you see in bold a section referencing the PUA limitations. So specifically, this reads, this illustration shows one or more PUA payments after year 1 that exceed a specified multiple of the base policy premium. The multiple is 3 times the base policy premium in years 2 through 10 and 1 times the base policy premium in years 11 and later. Payments in excess of this limit are subject to approval. One of the conditions may be that the insured provides satisfactory evidence of insurability. Okay, so what does this mean? A lot of language there, and it can be confusing. What this is stating is if I have a policy set up, back to the illustration, we had $50,000 per year going into the policy. What was my base premium? $5,000. This language, which is part of the full illustration, exactly the same as those numbers we just showed, states that years 2 through 10, I can pay 3 times my base premium into PUAs per year. If I have a base premium of $5,000, this means I can add another $15,000 per year in PUAs on top of that for a total of $20,000 a year. We illustrated $50,000. That contradicts itself right there. Years 11 forward, it states if I have a $5,000 premium, how much can I add in PUAs? 1 times that amount. That's another $5,000 on top of my 5K base, a total of $10,000 per year. So a client reads this or a competitor points this out. Remember, I am showing $50,000 per year for 15 years. This language states that you can't do that, Mr. Client. Could have a potential problem on my hands. Here's the thing. When we look at a Guardian life insurance policy, this language that we just went through is stating the PUA limitations on a policy if we have the basic paid up additions dividend option selected, just a basic whole life policy. If we have the policy set up like we did when we go back to the illustration, we had a level death benefit. The specific dividend option for this policy is a level Q term, dividend option Q. What this does, so if you go back to the numbers here, what do we see? We see $50,000 a year going in, net cash value is strong up front. Look at our death benefit though on the far right. Each year, as we pump money into the policy, as we pump money into PUAs, with a basic whole life policy, that death benefit would increase. Here, it's level. What's happening? Look 2 columns to the left of the net death benefit, face amount of 1 year term. As my whole life grows, really from those PUA payments and dividend accrual, my whole life death benefit increases, my term decreases, keeping me level, so the company will allow me to continue to contribute 10 times my base premium if the policy is set up in this manner. Okay, sounds great, but how do we prove that? A client says, okay, Steve, that all sounds great, but I have to have it in writing. Well, let's show it to them in writing. So in the full illustration, page 3 highlights Guardian's basic PUA limits. And that's what can cause some issues for us. What we've got up here is a full contract. So this is about 100 pages. I should say we have 1 page from the full contract that specifies the PUA limits and the exception if I have the policy set up properly. So in this page, if I've got a full policy from Guardian, if I have the PDF version, I'd encourage you to pull it up on your computer, hit Control F and search maximum PUA payment limit to get to this section because this contract is very thick. Here, under this section regarding the maximum PUA payments, firstly, we see that the company refers to the basic PUA rider specifications, 3x during the first 10 years, 1x thereafter. However, we have highlighted in yellow here, plus the amount of any target face amount associated with any 1-year term insurance with target face amount rider attached to the policy. So what does that mean? Well, if I have that dividend option selected, level Q term, that means I've got that decreasing term rider attached to the policy. What this contract language is specifically stating, the basic PUA limits are enforced, plus I can add plus PUAs that may be added to the policy that buy down term insurance, meaning Guardian will accept 10x the minimum base premium to be paid into the policy per year without any medical underwriting, provided this term rider is attached. If the term rider is not attached, if we chop it off or it naturally expires, then my PUA limitations are going to go back to the default contract language. Another piece we see. So next we're going to pull up a piece from Guardian's home office. This is a rider manual. And on the bottom, well, first underneath maximums, you're going to see similar maximum limits. I can pay 3 times the base premium in PUAs, years 1 through 10, and 1 times thereafter. However, under exceptions here, we have highlighted in yellow. What do we see? Second bullet point, or I should say the first bullet point there. In any year, the owner can buy any face amount of PUA up to the difference between the option Q target, that's my term rider, and any existing additions. So I can plow money into PUAs well beyond the 3 times limitation and not have to go through any medical underwriting. This is critical. So if the policy is constructed properly with Guardian, I can pay in well north of 3 times the PUA limitation. Now, we state all the time, I can pay 10 times, or you, the consumer, can pay 10 times my premium in PUAs per year. In the full contract language, and in this piece right here as well, we don't see that limitation anywhere. So where do we get this 10x limitation from? Well, we're going to pull up another piece here, and this specifically has to do with Guardian's software. So when we run a Guardian illustration, here we're going to see some software limitations they have, that when we have the level Q term rider, or I should say the dividend option Q attached to the policy, we see that the maximum illustrated PUA is, guess what? 10 times the base premium or $500,000 per year. So that's their annual cap. A consumer can pay $500K per year or 10x the base premium. And this is directly from Guardian. If we tried to illustrate a number greater than that, if I tried to illustrate $1 million in PUAs per year, or if I tried to illustrate 30x the base premium in PUAs, Guardian will not let me do this. So can I have a Guardian policy where I can plow money into cash just like I saw in that illustration, $50,000 for 15 years? Yes. If your competition points out to page 3, hey, look at the limitations here, that is true, depending on how the policy was constructed. We want to have the data, the evidence that we just went through from the full Guardian contract, their rider manual from their home office, and then also we have this piece, or the last piece we just saw, specifying their illustration limitations. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.